So we're still on Chapter 8. This is Learning Objective 3, how we value accounts receivable. When we talk about valuing accounts receivable, we're really asking at what amount are we going to report these on our books. And so when we make sales on an account, in other words, we made the sale but we haven't gotten the money yet, we make this journal entry, accounts receivable and sales revenue. And so in doing this entry here, we're recording on our books an asset, accounts receivable, of $1,000. And so that's what we would be valuing this at. And so, but when we value it at $1,000, we're assuming that all of these are going to be collected. In other words, all of our customers are going to send us checks for what they owe us. They're going to pay us. So we build 1,000, we collect 1,000. But that's not a valid assumption, because some of our customers will not pay us. They may pay late, they may not pay at all. So the value of that account receivable is really somewhat less than $1,000. So knowing that we shouldn't overstate our assets, somehow we have to account for the fact that we probably won't collect all of our accounts receivable. There's two main methods to account for bad debts. So here's our two methods. The first is the direct write-off method, and this is not generally accepted accounting principles unless your bad debts are not a significant part of your business. In other words, if they're insignificant, not material, you can use the direct write-off method. With the direct write-off method, you don't make any estimates of bad debts. You simply, when you have, say our customer, say we have a customer named Fred who decides, we know he's not going to pay us, he just declared bankruptcy, and so he owes us the $250, so we would go bad debt expense. This goes on our income statement. It's an expense like any other. And then we would write off Fred's account receivable for $250. And that would be the end of the story. This is the method I used when I was running my construction company, because we had very, very few customers who didn't pay us. Most of our work was done under contract, so that we didn't do the work until we got paid. In other words, we would have a lot of the payment done before we did the work, and then the rest was under contract. Over 10 years or so, I think I wrote off maybe $300 in, I wrote off one bad debt for $300. So that is a justifiable situation for using the direct write-off method. Bad debts are insignificant, not material, they're an extremely small percentage of your sales. Most companies are required to use the allowance method. Okay, so with the allowance method, I think I'll leave this same account receivable up here, but let's go to the allowance method. Now the allowance method is GAAP, okay, so we're working with the allowance method. And under the allowance method, we're going to take that same sale on account. In other words, we have accounts receivable and sales revenue. Except that now we know that in our business there's usually a significant amount of accounts that we don't collect. And so we're going to have to use the allowance method. So based on past experience, we're going to assume that we usually wouldn't collect about $200 of this. So we can't just reduce the account receivable, from 1,000 to 800, because that wouldn't really make any sense from an accounting point of view. And we're only estimating, we're kind of guessing that we won't collect that, but we don't know for sure that we won't collect it or how much we won't collect. And we don't know which of our customers won't pay. So we're going to leave the account receivable on the books at $1,000. But we're going to use an allowance account to show how much of that we think we will not collect. So we're going to use an allowance for doubtful accounts to show our financial statement users how much of that receivable we expect to collect. So our balance sheet would look like this. If we were doing a balance sheet after we had estimated our bad debts using the allowance method, we'd have our balance sheet, we'd have our assets, and we would have accounts receivable. They would be on the books at the $1,000. And then we would go less the allowance for, I think I'll move this over a little bit, for doubtful accounts. Let me, doubtful accounts. So we would have accounts receivable 1,000, and if we thought 200 wouldn't get collected, we say less allowance for doubtful accounts, 200, and that would leave us with a valuation on our balance sheet of 800 is what we actually expect to collect. So someone reading the financial statement would look at this and they could interpret what it means. It means we had sales on account of $1,000. We've got the accounts receivable of 1,000. But based on past experience, we think that 200 of that will not be collected. And so we really expect to collect 800. What we call this 800, and it wouldn't be labeled as such on the balance sheet, but what it is the net realizable value. Okay, so net realizable value. But that would not show up on the balance sheet. But that's what it is. That's a term that will be used to describe that. Okay, so net realizable value, that's really equal to the amount that we expect to collect. Okay, so let's see how this allowance method works. How do we, accomplish all this? And so I'm going to go to the journal entries we would use. Now that we've seen where we're going, this is kind of how we get there. So the first thing we're going to do is we've got the journal entry to recognize the sales, and when at the end of the period we would make a journal entry to actually, let's see. So to recognize the bad debt expense we believe are going to be associated with that accounts receivable. So we would go bad debt expense, and we would credit that allowance for doubtful accounts. I'm going to go allowance for doubtful accounts, if you don't mind. And that would be for the 200. Okay, so let's think about this for a minute. We've recorded the bad debt expense of 200, even though none of our customers have not paid yet. Okay, none of our customers have not paid yet. This is just an estimate of the amount that we think is going to go uncollected. This 200 of bad debt expense is going to show up like any other expense on our income statement. It's going to be deducted from our revenues. It's going to lower our net income. And so the allowance for doubtful accounts, as we just saw before, is going to be reported on the balance sheet. And the allowance for doubtful accounts is a contra asset account. It's a contra account to accounts receivable. So it reduces the valuation of the accounts receivable. It's its friend, it goes along with it. Another contra asset account that you are already familiar with is when you have property, plant, and equipment, less accumulated depreciation. The accumulated depreciation, contra asset account for the property, plant, and equipment. Same idea here. Okay, so this is what happens based on, our accounts receivable and sales revenue. This is our estimate. So now what happens when we actually have someone who doesn't pay? Okay, so say on on 10/15, or I don't know, 10/30, we've got a customer who owes us $50 and actually isn't going to pay us, declared bankruptcy, we're not going to see it. In that case, when we have an actual write-off, we would debit the allowance for doubtful accounts, and we would credit that particular account's receivable. Okay? I'm just going to say it's Fred again. Okay? And say it was for, I don't know, $50. Okay? So we know that he's not going to pay, and so we've written off the accounts receivable that he owes us has been reduced to, you know, to zero, and the debit goes to the allowance for doubtful accounts. So this is, we've set this up here as the estimate. Now we've used up $50 of that. Okay. So we've estimated that 200 would not be collected. And now we know that of that 50 has really not been collected. So we've got 150 for other people who might not pay us. Okay. Now the other thing that happens, so here, this is for an actual write-off. Okay, that's what we did here, an actual write-off. What happens if Fred hits the number and decides, oh, I think I'll pay them after all? We've written off his account. So, you know, maybe the next year sometime, maybe in March, he decides to pay it. Okay, so we're in the next year, and, you know, it's all been written off, and so we'll keep it simple. We'll keep it the same year. On 12/30, he comes into some money and decides to pay us. Well, if we know we're going to have to debit cash, but we don't have any receivable to reduce because we wrote it off. So the first thing we have to do is to reverse this entry and put that receivable back on the books. So we would put the account receivable back on the books. We would say, okay, we're going to collect money on this, so we can put the allowance for doubtful accounts, we can put that back in there for somebody else. Okay, so now we've got the receivable, and so now we can record the receipt of the cash that he sent us and reduce the account receivable that we just put back on the books. Okay, so that's how you treat that. So this is an actual write-off, and this is you have to reinstate the account when they pay after they've been written off, after a write-off. And these things happen, and so you just need to know how to handle them. Okay. All right, so when we reinstate the account, we're putting the $50 back into the allowance, saying, yeah, we thought we needed that for a bad debt, but now we've actually collected it, so we can put it back in there for somebody else to use. When you're working with these, sometimes T accounts are good, but I think I'll go into that more when I go over some of the actual exercises for this.